Hello everyone, welcome to these series of videos on the basics of supply chain management. Today we're going to talk about what are the financial metrics that are important to keep track of to see how healthy your supply chain is. So measuring the health of a supply chain is very important. In the last video, we talked about the important drivers of supply chain performance. So we looked at inventory, pricing, transportation. These are the three logistical drivers, and we looked at the six drivers of supply chain performance. Can't remember them offhand, but yeah. So these are the six drivers: facilities, inventory, transportation, information, sourcing, and pricing are the cross-functional drivers. So we looked at these six drivers, and we saw what are the metrics that are important to when one of these drivers is the main driver of your supply chain, right? So for you, facilities might be the big driver. Let's say that you run a series of warehouses that you rent out to other people, then facilities and inventory are the big pieces of your supply chain, maybe transportation a little bit, right? Sourcing and pricing, not so much. But if you're running a fleet of trucks, then transportation and pricing become important. Sourcing, inventory, information, inventory maybe a little bit, but facilities and information are really not that important. So there are important So of these six drivers that you have, some of them will be important, some of them not. And based upon that, you will decide which metrics to track. So when you are a CEO or CFO of one of these of a large company, you will usually have a dashboard that tracks important metrics to your particular company, right? And based upon the drivers that are important, you will have these supply chain metrics as part of your KPIs. Now, other than that, obviously, you need to know how well financially your company is doing or your supply chain is working. And for that, we need to know what are the financial metrics that are important to measure the health of supply chain, and that is what we're going to be talking about today, right? And we will begin with looking at so this is some basic data for Costco and Nordstrom from 2023, and one of the first important metrics that is important for measuring the health of a supply chain is the idea of return of equity. So from a shareholder perspective, return on equity is the main summary of a firm's performance. So this measures how well a firm is doing based upon how much money was invested in, right? So the net income divided by average shareholder equity, that gives you the total return on equity. So when you have data here, so you know what net income is, and you also have some shareholder equity numbers. So based upon that, you can calculate the return on equity numbers, right? So that is one of the important measures of performance. Now, this is not just for the supply chain. This is for the whole firm as a whole, but we'll also get to some metrics that are important just for the supply chain, right? Now, return on assets. Now, return on assets is again an important metric. That's again more supply chain oriented, but also important for the whole firm. So there are two ways of calculating it. One is earnings before interest divided by the average total assets. And you might have earnings before interest directly in the data that you have, or the way you calculate earnings before interest is you take the net income and you add interest expense minus the tax rate, right? So you take out the amount that you pay as tax from the interest expense, and you add that to net income. That gives you the earnings before interest, because we're not including the tax rate. Earnings before interest, and we divide by the total average assets, right? And that will give us the return on assets. All right. So to measures that are not part of financial statements, so you can have two measures that are not part of the financial statement. So you have markdowns and lost sales. So this is not something that you usually see, but because we're looking at average values, so sometimes you might have had a sale where the sales price is much lower. So the average amount of sales that you have, you will have a lower number there, but then you average it out for the whole year. So that's actually what you see. That's why you don't likely see it on financial statement, and the same goes for lost sales. If you have lost inventory or anything like that, you tend not to see it on financial statement. All right. Now, based upon the financial data, here are the important metrics. So you have return on equity and you have return on assets. So return on equity for Costco was 25.11%, while for Nordstrom it was 15.8%. Now, is 25.11% good? Is 15.8% good? Because remember, Costco and Nordstrom are in very different businesses. Costco is in the supermarket, in the warehouse, so supermarket warehouse business, while Nordstrom is in the clothes business, right? So how do you tell if 25.11 is good or not? There are two ways of doing this. All of these metrics tend to be relative metrics. That is, you measure them, you compare them with something else. So two things you can compare them against Costco's performance from last year and over the last decade, or you look at similar firms and you look at their performance. So you could look at Walmart's performance or Sam's Club's performance, right? Or you have BJ's. That's another large local warehouse chain. So you look at all of these warehouse chains, look at their return on equity, and then you can compare your return on equity with those return on equities, right? And same goes for return on assets. So these are all relative metrics that are important, right? There are some non-relative metrics also that are important, but I will get to that in a second. So you also have profit margin and asset turnover. So we'll get to that in a second. So once you calculate, so the other way of calculating return on assets, so I said that there are two ways of calculating return on assets. So one is to calculate earnings before interest and divide by the total average assets, or the other way of calculating return on assets is you calculate earnings before interest and divide that by sales revenue, which gives you profit margin. Then you take sales revenue and divide by total assets, which gives you asset turnover, right? So how quickly you're turning over your assets. And then you multiply these two together to get return on assets, right? So those are the two ways in which you can calculate it. And right here, you'll notice that 8.69% is the return on assets. So if you multiply these, the profit margin with asset turnover together, you'll end up with 8.69%, right? 2.48 times 3.51 is 8.69, right? That's the idea, right? Okay. Now the other important financial measures of performance, and these are especially important for supply chain performance, is the accounts receivables turnover, the inventory turnover, and the accounts payable turnover. Now, PPE turnover is also important, equipment turnover is also important, but not as important as accounts receivable turnover, accounts payables turnover, and the inventory turnover, right? So let's quickly talk about inventory turnover, then we look at the accounts receivable and accounts payable turnover. So inventory turnover measures the total, you can measure that by taking the total cost of goods sold divided by the inventories that you hold, right? So how much money did you make by selling everything that you were selling and of the goods that you were selling, and divide that by the inventories. Now this is important to know that this is COGS or COGS. So COGS divided by inventories, the total amount of money that's tied up in inventory. That gives you the inventory turnover, right? And then, of course, the two other important metrics are the accounts receivable turnover and the accounts payables turnover. So how do you calculate these? So the total sales revenue divided by accounts receivable. So what is accounts receivable and what is accounts payable? I'm sure you guys already know this, but quickly, accounts receivable is how much money you expect to receive from your customers, right? So you're selling to your customer. So if you're Macy's selling to your customer, you're immediately getting the money, right? So somebody's buying a t-shirt, they're giving you money for the t-shirt right away. But let's say you're a company that is selling to another company, and the way usually accounts receivables work is you send your goods to them, then you send an invoice, then they'll pay the invoice, right? And this might happen, so based upon the contracts that you have, this might happen every week, or it might happen at the end of the month, or it might happen every quarter, depending upon how much business you do with a certain company, right? So accounts receivable turnover tells how quickly you're able to receive money from your customers, right? Inventory turnover tells you how quickly you're able to turn raw materials into finished goods. So keep this in mind. This is important. And finally, you have accounts payables turnover. This is how quickly do you pay your customers, right? So you have cost of goods sold divided by the accounts payables. This is how much money you owe your suppliers, not your customers, I'm sorry, your suppliers, right? So these are the three different pieces. You have what happens to the raw materials. So you're paying your suppliers for the raw materials. Then you're converting raw materials into finished products. And then you're taking the finished products, selling it to your customers, and the customers are paying you, right? So this is the total cycle that's happening within your company. And to measure how much money is tied up in the cycle, you calculate something called cash to cash cycle, which tells you roughly how many days it takes for money to enter the process and then gets collected as revenue, right? So how long between you spending the money in making something to you getting the money for the final product. So how long does that take? And that's the cash to cash cycle. So to calculate that, you'll notice that we are going to take the reciprocal of the accounts payable turnover, because accounts payable turnover tells you how long it takes, right? or what is the time difference between the money your customers sending product, sorry, your supplier sending products to you and you sending money to your supplier, right? So taking the reciprocal of that. So this, if you can delay payables, then you're essentially delaying how much money you put into the process. So that's why it's a negative. So negative 1 over APT. Then you have inventory turnovers, because this measures essentially how long it takes for you to convert the raw materials into a final product. And then of course accounts receivable. How quickly do your customers pay you? So if you calculate this whole thing, it tells you how long did $1 go from your hand to becoming $1 that you get from your customer, right? So how long does that take? That's the cash to cash cycle, right? So, and for the data that we had before, you can see the calculation of return on equity, return on assets, profit margin, asset turnover. Then you have accounts payable turnovers, accounts receivable turnovers, then inventory turnovers, PPET turnovers, right? And finally, the cash to cash cycle. So you'll notice that the cash to cash cycle for Costco is negative 1.43, while the cash to cash cycle for Nordstrom is negative 33.38. Now, the reason why negative makes sense is because it means that Costco and Nordstrom are never spending any of their money. What they're essentially doing is they are delaying payments, not delaying, the contracts that they have signed is in such a way that they don't have to pay their suppliers before they get money from their customers, right? So this is essentially a good thing for them. Having a negative cash to cash cycle means that you don't have to spend money before you get the money, right? And that's the idea. And these are the basic financial performance, important financial performance metrics. And it is always good to know how your company is doing. And cash to cash cycle is something that I want you to very clearly understand. So this is negative because if you delay this, so you're essentially paying your suppliers. So that's essentially what both Costco and Nordstrom are doing, that before they have to pay their suppliers, they're already selling their items that they have and getting money from the customers, and then they're using that money to pay their suppliers, right? So that way they don't have to spend money before getting money. And this is not always true. So if you look at a company like Boeing, for example, where they make airplanes and sell airplanes, then their cash to cash cycle is measured in years. Not in days, it's measured in years, and it's always positive because they have to make the planes before they sell them. They might have orders already placed. They might have, say, some money like a 5 or 10% deposit that comes from companies that are buying large number of aircraft, but still much of the money that they collect after the aircraft is delivered. So they have a positive cash to cash cycle. All right. And that's those are the financial performance indices, and yeah. So that's all I want to talk about as far as financial indices are concerned, which measure the health of a supply chain. And this sort of ends my basic foray into basic supply chain management. So we talked about basics of supply chain management. We talked about the drivers of supply chain performance. We looked at financial metrics. We also looked at how you achieve strategic fit within a supply chain. All of these videos are available to you, so make sure that you watch them if you want to go through all the basics of supply chain management. All right, I'm going to end this here. This is it for this week. I'll be releasing more videos next week. All right, take care.